Good afternoon, folks. This is Ed Jameson. About 2 o'clock here in the Boston area. I appreciate folks taking time out of their day to join us. I think for the 3-day event, we've got about 250 people registered. I think we're expecting people to sort of come and go over the next 3 days. The goal here is to educate you as to how government funding works, and to try to give you some insights as to the sort of common mistakes that we see and how to avoid those problems. So I'm a 55-year-old man, and I've been doing this for 41 years. So I usually let people do the math in their head. So when I was 14 years old, I was in middle school. I used to play catch with my dad in the backyard every day before dinner. And one day I got home from school at 2:30 in the afternoon, and Dad was already home from work. And wasn't really sure what was going on, but at dinner he told me and my sister that he'd lost his job and that he wasn't sure how he was going to put food on the table, but he was going to start his own business. And I said, geez, Dad, I really like to eat, so if there's anything I can do to help, let me know. What I didn't realize was that my dad was a division controller for the Honeywell Electro-Optics division. He was a government contract accountant. But to make a long story short, when I was 14 years old, he taught me how to reconcile bank statements. By the time I was 16, he taught me how to prepare corporate tax returns. By the time I was 18 years old, I had a $40,000 book of business of pizza shops, canteen trucks, hair salons, anything to make a buck. We did it. But what I really didn't fully appreciate at that age was that my dad lost his job with about 300 other people that day. Honeywell had lost a huge government contract, and a bunch of scientists and engineers that my dad worked with were suddenly out of a job. And my dad became sort of their part-time controller and CFO. So at a very early age, I was also learning about the Defense Contract Audit Agency, federal acquisition regulations, and sort of how the federal government funded very early stage R&D and assisted entrepreneurs with endeavors that most people wouldn't invest in until they're more mature. So bought my dad out about 20 years ago and really made the focus of the firm to provide outsourced, FAR compliant accounting solutions. So at one point we were a full-blown CPA firm, and what we realized was that when we would go into audit people, they thought they were okay and they weren't. And we wound up having a lot of clients with problems because we knew what they were doing and they didn't. And we changed the focus of the firm to sort of become our client's internal resource as opposed to an independent CPA firm. So we've got 4 levels of accounting solutions that we provide depending on sort of where you're at with your business and your government funding. All of our accountants, all of our account managers are CPAs with about 15 years of accounting experience. Some of them have master's degrees. It's kind of interesting when we hire a CPA with 15, 20 years of experience. It typically takes them a year to understand how to fill out the forms and how to deal with some of the basic compliance issues. And it really takes them probably 3 years before they really understand a lot of the nuances and really understand the depth of you know, the compliance and audit issues that are involved. And it's really like 3 years before we would allow them to hop on a plane and represent you during an audit. So if you're new to this and you're a little bit overwhelmed, don't be. You know, we deal with this sort of every day. And that's really the reason that we're having this 3-day webinar. We've got clients in 41 of the 50 states. Over the years, we've helped clients procure, manage, and survive audit on more than $5 billion in government funding awards. That's B with a billion with a B. I've been speaking at the National SBIR conference a couple of times a year, probably for about a decade now. And I really enjoy sort of getting in front of a crowd and educating them and sort of hearing their stories as well. So let me give you a background on what I'm going to try to cover in the next hour today. So today we're going to focus on indirect cost rates. Tomorrow we're going to talk about what it takes to set up a federal acquisition regulation Part 31 or FAR Part 31 compliant accounting system. And on day 3, on Thursday, we're going to talk about the audits that occur so that you're fully aware of sort of the main pieces of how this works. So I'm going to give you a little background today on indirect cost rates. I'm going to talk about cost proposals versus reality. We're going to talk about direct, indirect, and unallowable costs. And it's important to understand that we're not talking about cash flow. We're not talking about anything but coding when we talk about direct, indirect, and unallowable costs. So you're spending money, but it's literally how do you code it that matters. And we'll get into that in some detail. We'll talk about how the government sees indirect cost rates and what they think is reasonable and unreasonable. And then what I'm going to do is I'm going to show you how to build an indirect cost rate from the ground up in under 20 minutes. I'll probably spend 5 minutes, but when you do it yourself, it'll take you 20 minutes because I do this for a living and you don't. The nice thing about the indirect cost rate templates that I'll show you how to grab off our website for free, if you just give us a buzz, we're happy to sort of review them with you and give you some feedback. It just sort of as a way to build some goodwill with you and you know, get a little rapport going. So before we really dig into this, I think it's important when you're thinking about indirect cost rates that you think about how are you going to use government funding to develop your business. So are you going to get one award and be done with it, sort of like Qualcomm, or are you going to use, you know, a series of, you know, SBIR and non-SBIR funding over the next decade to sort of develop what's a very early stage scientific discovery? You know, another question that I really like to ask is, if you win, will you have a project or a business? And I don't mean that to be an insult, but I mean, quite honestly, a lot of our clients, when they start, they don't know if the project is going to be a success or not. They're in an incubator, maybe they're in their house, they're still working out of their office at their university. But at some point, the project morphs into a business, and we're going to talk about sort of what that looks like. And that's a really critical inflection point for when you just have to get this indirect cost thing right. And then finally, for our NIH crew, there is, you know, 2 pools of money that are available in the SBIR program. One is for VC-backed companies, and the other is for bootstrapped companies. Our experience with VCs is they don't really care about your indirect cost rate. They sort of see the SBIR program and some of these other government funding programs as just free money or money that they don't have to come up with. So they typically will use de minimis indirect cost rates. So if you're just flush with, you know, tens of millions of dollars in cash and you've got VCs that really don't care, this is probably an hour that you could spend doing something else. But if you're bootstrapped or if you care about your cash flow, I would really hope that you would stay tuned. So we blog fairly frequently. We're somewhat into social media. And recently we came out with the sort of the top 10 mistakes that we see new SBIR, STTR companies making. And by far, the #1 mistake that we see is new contractors and grantees proposing indirect cost rates that are just way too low. And if you don't really get anything out of today other than this one point, unless you have a written negotiated indirect cost rate agreement with the federal government, you are not allowed to bill for indirect costs greater than what you proposed. So if you proposed $15,000 worth of indirect costs in your proposal, that's all you can bill the government for. You may not rebudget from a direct cost category to pay for indirect costs not in your cost proposal. However, you may rebudget from indirect expenses to direct expenses. So if you budgeted hundreds of thousands of dollars for indirect expenses and you didn't need it all, you can take that money and rebudget it and spend it on direct labor, direct consultants, direct subcontractors, or whatever. So the real question that we have here is, do you want some flexibility or none? So we've been doing this for a long time, and I have to be honest with you, we see prospects come through the door with absolutely ridiculously low indirect cost rates, and we ask them the question like, how did you come up with that number? And these are sort of some of the things that we hear. Oh, a colleague at MIT told me to use 10% and I'd win. Our grant writer told us to use this rate. Oh gosh, this is really competitive, so we thought it would be better to be low. The benevolent answer, we wanted to dedicate as much money to the science as we can. We used the agency's template and backed into this number. For the NIH crowd, you know, we didn't want to get audited, so we used a 40% F&A rate. And, you know, these are all the reasons that we hear people using to put themselves in this very tight box with very little indirect rate budget and no ability to rebudget. So before we get too far into the subject matter, we've got to really understand the difference between a direct and indirect and an unallowable cost. So part of our webinar tomorrow, we're going to be talking about how to set up a FAR Part 31 acceptable accounting system. And one of the most important things that this accounting system needs to be able to do is segregate costs between direct, indirect, and unallowable. So when you pay an expense, is it a direct cost, an indirect cost, or an unallowable cost? So really, when you think about direct, indirect, and unallowable, what I really want you to think about is, who does the expense benefit? So in this example, we've got a list of indirect and direct expenses. And what we're doing here is we're just trying to think about it from an objective perspective of who benefits from this. Now, if you've only got one grant or contract, it's very difficult to sort of draw a mental line between direct and indirect. So if you've only got one funding award, I want you to pretend like you've got two or three of them. And then I want you to think about the expense that you're trying to code, and I want you to think about, who does that expense benefit? So if you've got a direct consultant's bill in front of you, they worked on project or grant one, and that was the only project that benefited. So that's a direct cost. The definition of a direct cost is, if it weren't for this project, I wouldn't have incurred this expense. And you can say the same thing about materials that were purchased or subcontract costs from Johns Hopkins or UC Berkeley or Northwestern or wherever. If it weren't for this project, I wouldn't have had this expense. Now, the next grouping of expenses, rent, utilities, and telephone. Well, geez, all my three projects benefit from having a facility and from having electricity and from having a telephone. So those are all indirect expenses. Those are expenses used to run the business, and they benefit all of the projects, both government and commercial. And that's a very important thing to discern against. And then finally, we've got what the government considers specifically unallowable expenses. So you've got interest expense, alcoholic beverages, federal taxes. These are legitimate business expenses that the federal government just won't reimburse you for. So for tax purposes, you know, interest expense and alcoholic beverages, you know, may or may not be tax deductible, but the federal government is not going to allow you to charge them for those expenses. So now that we've got a baseline, let's get to reality a little bit. So a lot of you are writing proposals, and then you wait for 6 months and you get your initial funding, and you know, as you start working, things change. You know, we've worked with some of the most brilliant people in our country, you know, and not one of them was bright enough to write a proposal and have it exactly come true a year later as they were working on the project. So the federal government doesn't want you calling them saying, "Mother, may I, spend the money I was going to spend on this to spend on that." So they have these rebudgeting thresholds, and these are rules of thumb typically for the SBIR program. NIH has very liberal rebudgeting thresholds. So if you had $1 million phase 2 award, they will allow you to rebudget $250,000 or 25% of that without question. So I was going to subcontract this, and now I've decided to do it in-house. As long as it's under 25% of the total award, they're fine with it. The Department of Energy tends to be about 10%. NSF tends to be about 5%, much stricter with rebudgeting. But again, you're only allowed to rebudget between direct cost categories. You can't rebudget from direct to indirect. You can rebudget for indirect to direct, but not from direct to indirect. So if you blow your indirect budget too low, you are putting yourself in a little closet and locking the door. So now let's talk about some really specific things, and I think these three expenses sort of make some key points. So I did a webinar for the Principal Investigators Association a while back, and one of the gentlemen after the webinar called me up and he said, "Hey, Ed, is a lab jacket a direct or an indirect expense?" And as I mentioned, we have a lot of really bright clients. So rather than just answer the question the way I thought it should be answered, I said, "Well, that's an interesting question. Why do you ask?" And he said, "Well, we do this one particular bovine experiment, and when we do, it ruins our lab jackets." So this gentleman was cutting open cattle, and the cattle blood was getting all over the lab jackets, and they were going through a lot of lab jackets. And I said, "Oh, in your specific example, the lab jacket is a direct cost, because if it weren't for this project, you wouldn't keep going through these lab jackets." So for most of our clients, a lab jacket protects their clothing from all the projects they're working on. But in this particular case, the lab jacket was a direct cost of that project. And that's one of the things that I really want to make sure that you're aware of is there's a difference between an allowable cost and an unallowable cost. But direct and indirect is totally subjective to your business. And it's up to you to make the case to the federal government as to whether a cost is a direct cost or an indirect cost. And every situation and circumstance is different. Although there are rules of thumb, as you could imagine, every business is different. We also frequently get questions about employee benefits, medical insurance, can I have a retirement plan? The way the government sees this, every labor market in the United States is different. So if you are in Silicon Valley and you are trying to hire and retain an employee, and you're competing against Google for employees. Now Google picks the employees up, drives them to work, feeds them, does their dry cleaning, and drives them home. So if you're not offering a very generous employee benefit package, you're probably not going to have a lot of employees. We have clients in Iowa, and Ames, Iowa is a lovely place, but I'm quite certain that Google doesn't have an office out there where they're driving the employees to work, feeding them, and driving them home yet. And the government is very aware that labor markets are different, and all of these allowable, unallowable rules are really based on reasonableness. So is it reasonable in accordance with FAR Part 31? So is it reasonable in the government's eye? And then one of my favorite questions, accountants and lawyers, are those costs allowable? So the good news is the accountants who work on your business are always an allowable expense. With lawyers, it depends. What are they doing? So I'll give you an example. If a lawyer is helping you write a subcontract agreement, that's an allowable expense. It's a prudent, reasonable business thing to do. If a lawyer is helping you write an employee handbook, that benefits all of the projects, and it's a perfectly reasonable thing to do. If you hire a lawyer to help you do a Series A financing round, what you're effectively doing is transferring ownership from yourself to somebody else, And the federal government sees that as reorganization expenses. And the federal government doesn't care if you own the business or Joe, Steve, and Dave down the road own the business. They're not paying the lawyer for you to sell your business to somebody else. They don't get any benefit from that. So in accordance with FAR Part 31, those legal expenses would be unallowable. So you can see how this gets into, a little bit of slicing and dicing. And this is where, we talk a little bit about whether something is reasonable in accordance with FAR Part 31 or fantasy. So we've had a lot of clients who have fantasies about what they think is reasonable, and then we're constantly trying to reel them in with what the federal government or FAR Part 31 sees as reasonable. So a lot of times we get this question of, hey, is my rent an allowable cost? Now, typically when you think about rent, it's, hey, I'm going to go rent an office building and I'm going to represent my own economic interests, and there's going to be a landlord who represents his or her own economic interests, and at the end of the day, we'll negotiate on our own behalf and we will reach an arm's length agreement, and the government would see that as fair and reasonable. But what about when you rent from yourself? Now, fortunately, this next example, this next story isn't a client, but it's unfortunately a Purdue professor who finds himself in a little bit of trouble. So Hans Tech was a company that received $1.3 million in government grants and contracts over the course of 8 or 9 years. And the owner was a tenured professor at Purdue and decided to pay himself monthly rent of $3,000 a month. And he was going to set up an office in his home and pay himself rent. Doesn't seem particularly unreasonable to somebody who walks on the street. Let's keep going. So over the course of 8 years, the Purdue professor paid himself $150,000. Again, I'm not sure, Next line. Oh, by the way, the house cost $116,000. And just as another fact, he paid his kids, who are 14 and 9 years old, $24,000 and $10,000 a year to act as technical assistant and secretary of the company. He was indicted. So this is fantasy. It's not FAR Part 31. The government would not see this as reasonable. There is, in fact, when you rent from yourself, there's a formula that you have to use as to what is a reasonable cost to reimburse myself for this facility. So one of the things that we see a lot from people is, I'll ask them, how did you come up with that indirect cost rate? And they'll say, well, we use the government's forms and we work backwards. So I'll say, what does that really mean? Well, let me explain to you. So let's pretend that we're writing a phase 2 SBIR proposal, and we know that the maximum that the government will fund is $1.5 million. And we also know that the government will give a 7% fee on an SBIR proposal. So if I divide $1.5 million by 1.07, I know that I can get a $100,000 fee. So my costs are going to be $1.4 million. And then what people do is they say, okay, so we've got these 2 prominent consultants that we need to get into the proposal, and we've got these 2 big subcontracts with Johns Hopkins or UC Berkeley or whoever, and then we've got some employees that we need to hire, and the fringe benefit number and the indirect cost number are plugs. So I'm going to step back for a minute, and I'm going to explain a concept to you now known as the multiplier. And to a lot of seasoned DOD contractors, they would immediately know what a multiplier is. They'll talk about loaded rates, but when you're a newbie, this is a new concept, so it's an important concept to understand. So in my example, I'm using an NIH grantee, and this is how the government sees indirect expenses. So if I pay $1 for labor, how much do I ultimately charge the federal government? So in this example, this new grantee has a 35% fringe rate and a 60% F&A rate. So I take $1 in labor, I add my fringe benefits costs. The way their indirect calculations work, I then take an extra 60% of the total direct costs, and I get $2.16. I take my 7% fee, and I've charged the government $2.31 for every dollar I pay in direct labor. So that is my loaded cost. Now, in our experience, and this isn't based on data, but based on our 40 years of experience, our experience negotiating indirect cost rates for our clients in the SBIR program, what we see is sort of multipliers of 2 to 2.5 to be normal. 2.5 to 3.0, you start to get a little bit of pushback from the government agencies. At more than 3, the government sees you as prohibitive. Now, we've got clients who make cryogenically cooled microprocessing chips in their own foundry for the SBIR program, and their multiplier is greater than 3, and the government gladly pays them because Lincoln Labs can't produce these cryogenically cooled microprocessing chips. But the government also sees less than 2 as inexpensive. Now, if you go back to backing into the number, this indirect cost and this fringe benefit number comes out to be a multiplier of 1.37, which, if you go back here, is insanely inexpensive, right? But people do this because they don't understand normal tolerances. And we're going to get into a little bit about how to sort of think differently when you're writing your cost proposal. So cash flow problems become your reality if you actually do this correctly and you have totally underestimated your indirect cost rate. So if you're bootstrapped, what does this look like? Well, suddenly you've got a lot of credit card debt, you're borrowing from your savings and your relatives, you are prematurely diluting yourself, you're Series A financing because I need to come up with the money to pay the rent. And the one we see most often, and it's like totally shooting yourself in the foot, people stop paying themselves. Now, we always hear this sort of benevolent tone, oh, I'm doing this for free, and my time is worth $100,000 a year, so I'm going to charge the government $50 an hour for my time, but I'm not going to pay myself. We'll get into this in more detail tomorrow, but most of these funding awards are cost reimbursable awards. So if you don't pay yourself, your cost is 0. So you are entitled to reimburse yourself 0. You're entitled to bill the government 0. So if you fill out a timesheet and you pay yourself, and we'll get into this, there was a number of questions about timesheets and that sort of thing that we're going to get into in great detail tomorrow. But this is a critical way to just absolutely put yourself into bankruptcy. And when you look at the federal government, they talk about, financial risk. Which company has the most likelihood of going out of business? The one that proposed a ridiculously low indirect cost rate, or the one that proposed a reasonable indirect cost rate? And again, people will go, oh, I don't want to make myself uncompetitive. I don't want to get myself audited. Well, the SBIR program in particular is the most cost insensitive program there is. Now, we have clients out at the Wright-Patterson Air Force Base who are contractors on site there, and they will tell me, geez, Eddie, after the sequestration, we've never seen a government funding award to anybody that was more than 1% higher than the lowest cost bidder. That's not what we're talking about here. This is the SBIR, STTR program. We're looking for a cure for cancer. We're looking for a new way to store and transfer energy. This is not low-cost manufacturing. This is high-end, crazy, innovative science. And at the end of the day, the government would love you to come up with a solution, and they'd love you to be around so that they can continue to work with you. So this company here actually winds up looking more stable to the federal government. Now, the other thought process is, oh, is it going to make me more likely to be audited? Nobody wants to be audited, right? Well, the government deals with that, and we're going to talk about that on Thursday on day 3. How do these things get audited? But at the end of the day, the government sees this as a size of pie and a size of pie. They don't see the little slices. They just look at it and say, well, you know, if you're a DOE or an NIH grantee, once you've expended more than $750,000, that's kind of material, and so we're going to have you go through a uniform guidance audit. But underneath that, it's, you know, it's much more immaterial. With the Department of Defense, you won't even get your phase 2 without going through a pre-award audit. So the government isn't naive to this. The more money that's at stake, the more likely you are to be audited. So that's really sort of helping you put this thing into perspective. Now, really what a lot of this stuff comes down to is how do you code something? And one of the things that you have to be aware of is once you start coding your lab jackets as a direct or an indirect expense, once you start changing the way you code something, that's a change in accounting method, and the government says, well, why did you change your method of accounting? Well, I didn't. I just decided to code things differently because it's, you know, Wednesday or Thursday. No, that's not okay. So I'm going to talk for the next few minutes about things that people commonly charge improperly. So if you were to go through a uniform guidance audit or a DCAA audit, these things are, there's audit findings all over the place. So most people, when they're writing their proposals, don't estimate anywhere near the amount of indirect labor that there is actually going to have in their business. So when their project turns into a business and they go from paying people on an hourly basis to paying salaried employees want vacation, holiday, and sick time. They go to conferences. They write proposals. Who's managing the business? Somebody's managing the employees. Oh, the employee wants a performance review. The employee wants to know what you want me to work on today. Who's going to talk to the accountants? Who's coding all these expenses? Who's talking to the lawyers? Who's managing the subcontractors and the consultants and the vendors? These are all indirect labor activities. This is called running a business. You've got direct versus indirect equipment. Hey, this little unique piece of equipment is just for this project, or, oh, we use this table saw on all the projects. This material was just for this project, or really is this just like a lab closet full of, you know, a closet full of lab supplies, right? And, you know, one of the things that people tremendously underestimate is the cost of having an employee. Employees have payroll taxes, medical insurance, vacation, holiday, and sick. It goes on and on and on. So I'm now going to take you to a place where I would strongly encourage you to start when you're writing your cost proposal, and that is our website. So I'm going to pop out of here for a second, and I'm going to take you into our website. I'll use Chrome because I like Chrome better. So we're thinking of writing a proposal. Great. Go to jamesoncpa.com. Go about 25% of the way down the home page. I'm writing a proposal. Learn how to develop an indirect rate from the bottom up to stay cash flow positive. Free templates. There are 5 common indirect rate projection methodologies, all in an Excel format. Choose the one that is most appropriate for your business and agency. And I talk a little bit over here about the 5 most common types. Click, download. Here they are. And we have them for Mac and for PC, right? So I'm going to pretend you're an NIH grantee, and I'm going to open up a fringe and F&A rate projection. I'm going to enable editing. And what you're going to see is an Excel template with 3 tabs. So there's a labor input screen, there's an other cost input screen, and then there's the resulting rate calculation. And you'll see up here you've got a fringe and an F&A rate, right? So let's just walk through this, and in the next 5 minutes, let's just play pretend for a second, and then we're going to experiment a little bit. And I'm going to show you how to pretend and experiment a little bit. So let's pretend we're writing a phase 2 proposal, and my name is Steve, and I'm the PI, and I'd like to pay myself $150,000 a year because that's reasonable. And I'm going to spend all my time working on the project, and I've got Hannah, who is my right-hand person. I'm going to pay her $95,000 a year. And then I've got Joe, and Joe is 100%. And finally, I've got Dave, who is a technician, making $50,000 doing technician things, right? So I've got four, if I win this, $1 million phase 2 award, I'm going to have 4 employees. And then we go to the other cost input screen. And you'll notice that it's broken into sections. So we've got the payroll number already comes over, the FICA, FUTA, SUTA already calculated for you. And then we break it down into sections. So we've got fringe benefits. So if it weren't for an employee, I wouldn't have workers' comp insurance, health insurance, dental insurance, pension benefits, pension administration, disability insurance. Now, I don't need you to fill out every one of these rows. And you can see if you hover over these things, we talk about sort of what these are. Next section down, indirect expenses, indirect consultants, legal fees, business insurance, right? Then the next section, direct expenses, and then finally unallowable expenses, right? So, and there's 2 columns. One has an annual amount, one has a monthly amount. So let's just pretend for a second. So you've got a business, you've got 4 employees, you've won that phase 2. We're going to have $400 worth of workers' comp a year. I've got 1 employee. They're single. They're going to need health insurance. Boy, we're really bootstrapped. We're really young. We're not going to have dental and benefit. We're not going to have any of this stuff, right? Oh, we'll pay the lawyer $5,000 to kind of get us set up. We're going to have some office supplies. Let's say $10,000 worth of office supplies and computer supplies. And I'm not going to get into depreciation and all that other good stuff at this point. We're all going to have cell phones. So that's $400 a month, and we'll have some, the rent will be $3,000 a month. I don't know why my rent doesn't want to write. Sorry, folks, I must have clicked on something. $3,000 a month for rent. $500 a month for heat and utilities. We're in the state of California, so we've got $800 a year for state income taxes. We're going to use a payroll service. That's $100 a month. Let's put down $1,000 for lab supplies. We're going to outsource all of our accounting and bookkeeping to Jameson and Company. I don't know why this thing is not allowing me to type. Bear with me, folks. I've got some sort of a little glitch with my... Oh, type it over there. What are you doing? I think I've got so many users on the call that my system is just going real slow here. Sorry about that. So we're going to outsource all of our accounting to Jameson and Company so we don't have to deal with this FAR Part 31 stuff. And then we've got direct materials, $50,000. And we've got consultants for $30,000. And we've got $250,000 worth of subcontract work, right? So we've got 4 employees, we've got a bunch of expenses, and the resulting rate calculation is a fringe rate of 8.85%, and our F&A rate is 14.91%. I don't know what this Ed Jameson is talking about. Our rates are really low, right? Let's get real. First of all, let's dispel a couple of myths. So let's pretend, oh, geez, the rent, it's not $3,000 a month, it's $3,500, all right? The rate just went from 14.91% to 15.75%, not a big deal. Oh my gosh, those accountants and lawyers are so expensive. Listen, Jameson's charging $3,000 a month, oh my God. Okay, now the rate's at 16.5%. That's not what drives your indirect rates. Here's what drives your indirect rates right here. Your expensive people. Let's pretend we're not a project, but that we're a business. And we're going to start running this place like a business. And you know what that means? the employees are going to want a salary, and they're going to want vacation, holiday, and sick time. So let's be cheap. Let's give them 2 weeks of vacation. That's 80 hours of vacation, 80 hours for holidays, and 40 hours for sick time. So 5 weeks a year, the employees are going to get paid to not show up. Congratulations, you've now got a business, right? So if there's 2,080 hours in a year, but let's just use 2,000 to make the math easy, 10% of the time, you're going to pay your employees not to show up, right? And you're not going to be able to keep everybody busy all the time. So these guys are going to have, you know, things that they're doing. But here's what really is going to drive your indirect rates. Your really expensive people are going to be running the business instead of working on projects. Oh. Now let's take a peek at the indirect rates. Whole fringe rate went to 20%. Now the F&A rate's at 38%. Let's go back to this other cost input screen. Remember when I showed you, these aren't actually direct materials to a project. These are lab supplies. And this isn't a direct consultant chargeable to this project. This is an indirect consultant that we're using to help us, you know, run the business. Rate calculation, 59.78%. So it's the way that you charge or code your expensive people's time and all of these other big expenses that may or may not be project related. That's what's going to drive your indirect rates. So what I really encourage people to do is download these templates and sort of play with them and understand their tolerances. Then what we're happy to do is once you get to the point and you can take little, you know, you can go in here in the other cost input screen and you can make little notes, hit file save, email it off to Ryan, and we'll give you, you know, 10, 15 minutes of just free feedback about, you know, whether you are seeing the world the way we see the world or not, all right? So that's just a real quick, real quick thought on how to project an indirect rate from the ground up. And really what I want you to think about is what are your biggest indirect expenses? The most important one that you've got to think of is how are your key people going to spend their time? Are you running a project where 100% of their time they're working in the business and none of their time working on the business? Or are they spending some of their time working in the business and some of their time working on the business? So think about it. Am I working in the business or am I working on the business? So indirect rates give you the money to build your infrastructure, right? It allows you to hire people, acquire facilities, develop processes, and allow you to work on the business. The government wants to be able to buy solutions from you in the future, and they want you to stay in business, but they won't ask for the money for you. If you propose an indirect rate of 8%, they're going to assume that you have a way to pay for the other 58% that you're actually going to need. They're not going to be an advocate for you. That's what Jameson and Company does. Now, what a lot of people do, and this is why this scare screen exists, oh, geez, now that we understand how this works, no matter what we work on, we're just going to charge all of our time to direct labor, right? So this is why everybody cares so much about timesheets. So let's just read this. Company rated by the FBI. On January 23rd, a Woburn-based high-tech, now Woburn's in Massachusetts, right down the street from our office here, a Woburn-based high-tech firm who had received hundreds of SBIR and STTR awards was raided by the FBI for unlawful use of SBIR funds. According to court records, between 2009 and 2012, the company directed employees to charge labor hours that did not correspond with actual time and efforts to awards. Additionally, employees were given written instructions on how to change their timesheets and told how to destroy documents. The company and its president agreed to pay $2.25 million to resolve allegations of violating the False Claims Act. Folks, this isn't a joke. whistleblowers tend to get 10 to 15% of whatever the federal government can recover. So if you've got a disgruntled employee and you're telling them, I don't care what you work on, but charge that project, that's a huge no-no, a huge no-no. So let's sort of try to bring this around full circle, because again, this is a 3-day event, and I really want you to think about the cycle of indirect cost rates. And we're going to come back to this tomorrow and on Thursday. Your indirect costs are always evolving. So you write a proposal. Before you get funding, a lot of you will go through a pre-award audit. If you receive a cost type award, you are required to prepare an incurred cost submission annually. That incurred cost submission gets audited. And on an annual basis, the federal government asks you to update your indirect rate projection and use that in your proposal. So there's this never-ending feedback loop that goes on. Now, when do you call Jameson and Company? Well, here's the easy answer. When you're filling out the cost portion of your proposal and you're not really sure what you're doing. I speak all over the country, and people constantly grab me in the hall, and the question that they ask me is, am I okay? Am I okay? And I always ask the same question. Do you know what your actual indirect cost rates are running right now? Now, if you can't give me an answer, 27, 33, 55, right? You're not okay. You must be able to calculate your indirect cost rate on a monthly basis. If the government came in and said, hey, if we're reimbursing you for 50% indirect cost rate, how's it actually running? And you can't answer that question, you're not okay. We're going to talk about the Form SF-425 tomorrow. A lot of you NIH grantees wind up getting into trouble with this form. But if you've got concerns about your existing financial team, give us a buzz. Closing thoughts before we get to Q&A. Number one, don't set yourself up for failure by proposing an indirect cost rate that's too low. We know this is competitive, but it isn't low-cost commodity manufacturing. Go to our website, download the free indirect rate template. If you're not sure which one to use, just give Ryan a buzz. Build your indirect cost rate from the bottom up. Revisit it at least once a year. And understand that one phase 2 award is not going to get you to a $600 million buyout, right? So we've got time for a few questions. I'm going to get on my chat window and see if there's any in here. I don't see any. So if you've got any questions that you didn't give when you're registered, please feel free to use the chat window. I've got a couple of questions that were filled out when people registered. So I'm going to butcher this name. Anastine asks, at which stage in an award can we or should we bring on your team? Anastine, thank you for the question. When you're writing your phase 1 cost proposal, give us a buzz. We're happy to spend 10 or 15 minutes looking at it and make sure that you're setting yourself up to succeed. We don't charge for it. We're happy to do it. If your business doesn't succeed, we don't succeed. I mean, that was one of the lessons my dad taught me. Make sure the clients succeed. You'll never succeed if you don't help the client succeed, right? Juan, for a phase 2 SBIR from NSF submitted an indirect cost rate lower than or equal to the safe rate, what's the difference between monies from fee and monies from indirect costs? Well, Juan, I would tell you that the difference between monies from fee you can do anything you want with. Money for indirect costs must be spent on indirect costs. So I'm going to take umbrage with your asking for a rate lower than the safe rate, but it looks like there's a follow-on question here. It says, if requesting an indirect cost rate equal or lower than the safe rate, example, 50% for NSF or 40% for NIH, what's the difference between the monies received as indirect costs and those received as fee? Can either be used, for example, to cover patent costs? Okay, so patent costs are a funky thing. The Department of Defense will reimburse you for some patent costs. National Institutes of Health and NSF see this as a commercialization expense and treat it as an unallowable expense. So we'll get into this a little bit tomorrow. But there is the federal acquisition regulation is sort of a general set of rules that the federal government goes by. Each agency has the right to issue their own supplemental regulations, and they do. So the rules are somewhat different between the Department of Defense, National Institutes of Health, the Department of Energy, National Science Foundation. They issue supplemental regulations. So as an example, the salary cap for NIH is about 200 grand. For DOD, it's about 500 grand. DOD will reimburse you for internal research and development. NIH will not. DOD will reimburse you for some patent costs. NIH will not. So without understanding your facts and circumstances, it's a little bit difficult, but I can tell you, Juan, that if you're dealing with NIH and NSF, neither one of them is going to reimburse you for patent costs, but you can absolutely use your fee for anything. So patent costs, perfectly fine. Then his next question is, if audited either during or after the duration of a phase 2 SBIR by NSF or NIH, will we be requested to account for the money spent as indirect costs if we requested a rate lower than the safe rate? So the question is, if we ask for a safe rate, are we not going to be audited? So one, the answer to that question is no. Asking for the safe rate doesn't free you from being audited. So we're going to get into this on day 3 on Thursday. The way that government sees this, typically, an easy way to understand this is the more money they give you, the more likely you are to be audited. So with NIH and Department of Energy, those are granting organizations. If you expend more than $750,000 in your fiscal year, you are required to have a uniform guidance audit. We're going to get into that in great detail on Thursday on day 3. But no, asking for a ridiculously low indirect rate doesn't excuse you from these audits. Michael has asked a question. It says, my understanding is that training related to SBIR projects is an indirect cost, but is training related to non-SBIR projects also accounted for as an indirect cost? In other words, is indirect cost at the company-wide level and not at a specific project-specific item? Michael, that's exactly right. A cost is either a direct cost of a project or it's an indirect cost that benefits the entire business, and it should be paid for by everyone who benefits. So one of the things tomorrow I'm literally going to do is I'm going to show you 3 of the very basic schedules for an incurred cost submission and how those costs get spread and paid for by all of your grant, contract, commercial, internal research and development. Who pays for the rent? Who pays for the utilities? How does that work? So those are some great questions. I see we're right at the 50-minute point, so I think that's about enough for today. I'd like to thank everybody who came out today for participating. We will be recording today, and we will be posting all of this and giving it out to everybody on the weekend. So this webinar will not be available tonight. Sometime this weekend, you'll get an email from us with a recording of all 3 webinars, which will also be posted on our website. I'd like to thank everybody for joining us today. We will be live again tomorrow at 2 o'clock. If you have any questions you want me to answer, feel free to reach out to Ryan at jamesoncpa.com. Ryan literally sends me an email with the questions everybody asks, and if it's pertinent to the subject, I try to make sure I answer it. So feel free to ask questions. I know it's difficult airing your dirty laundry in front of a crowd, but if you're willing to do so, I'm willing to give you the answer. So I'd like to thank everybody for joining us today, and we hope to see you tomorrow. Thanks again.